Here. Thank you so much for joining, everyone. I'm so excited. I'm Sarah Johans. I am the president of the Minnesota Mortgage Association, and I'm delighted to have as our first guest for this year, Pete Mills. Pete Mills is he's got a massive pedigree. He's super devoted to our industry. He's got a lot of years as a financial executive. He's very involved in the government affairs and public affairs, government relations. He currently is a senior vice president of residential policy and member engagement at the MBA. And while he's in this role, he leads MBA's residential policy team and state and local advocacy program. He also directs MBA's residential member engagement efforts across the MBA value platform. So he's a really good connection for us. He's a wonderful source of information and a wonderful partner for the MMA. I'm so glad that you've all joined us to hear what he has to talk about. Just to give you a little bit more on Pete, he has, prior to being with the MBA, he served as managing director and co-founder of the Community Mortgage Banking Project, which is a public policy organization that represents the interests of companies and coalitions involved in housing and mortgage finance industries. So during his career, Mills led corporate public affairs for Countrywide Financial, managed trade association policy advocacy for the California Mortgage Bankers Association and the California Association of Realtors, and conducted housing policy research at the Federal Reserve Board. He has a BA in economics from the university, just a small institution out in California, the University of California, Berkeley, where he graduated with distinction in 1982. So we're very pleased to have you here. Pete, would you like to kind of highlight what I think you're going to talk about, sort of how the Biden administration is going to affect our industry, policy changes at the state and the national level, and how this might apply to our everyday kind of work. Do I have that right?
Absolutely. I'll cover sort of the transition process, a little bit of the personnel as policy types of issues. And then we did back in November, actually, a policy scan of what we call the possibility of, we did this in October, actually, possibility of a blue wave and what that might mean for the industry. So I'll cover those issues. I am very open to questions as we go. So if there are questions as we're going along, I'm happy to take them as we go. I thank you for the introduction. This is an invitation from the Minnesota Mortgage Association. I never thought I'd be invited back. Those of you who were there when it was on election day in 2016, and you guys had a conference, and I spoke at the conference. Spent the night before going through all of the latest polling that I could get my arms around, and confidently predicted that Hillary Clinton would win the election with over 300 electoral votes. Got on the airplane that afternoon and listened to that fall apart on the plane ride home. So I thank you for giving me that and for the opportunity to come back. If you want to advance the slide, let me, now that I can confidently predict that the Biden administration is in place and in charge, although even that was in doubt as early as the first of the month here. But let me kind of go through sort of where we are in the process of the transition process. The traditional transition process is largely over. We have acting secretaries in place at all of the agencies. Those are typically either senior advisors or what we call senior executive service folks who have been in those agencies for some time, are known to have, while they typically serve in nonpartisan roles, they are probably come from prior Hill experience, in this case on the Democratic side, but they're in charge and running things while the nomination process goes forward. So we're in the middle of that now. The early confirmations have gone smoothly. Janet Yellen at Treasury in particular, of importance to our industry. And the top spots at Defense and State and the Director of National Intelligence, those are all now in and confirmed. Those were what I would call fairly easy slots to get filled because the nominees were well known on the Hill and they were confirmed fairly quickly. Again, another number of key advisors not requiring confirmation are also in place at the National Economic Council, Domestic Policy Council, and those sorts of advisory groups within the White House administration. It remains to be seen how challenging filling out the rest of the cabinet and sub-cabinet slots will be. I think the days of getting the top slots filled quickly ended over a decade ago. I think both Bush and Clinton got all of their top cabinet slots filled, and that's secretaries, deputy secretaries, and those key roles, all got them filled out within the first 45 days. That has not happened since the Obama administration. There's been a lot of procedural delays thrown at the nominees, and it's taken a lot longer for the key agencies to fill out the full roster of appointees. I probably expect that this time around. Like I said, the early picks have gone smoothly. I think when we get into some of the other names, and I'll talk about them in a second, that process could slow down. But all that remains to be seen. The other key issue here, so the Georgia seat, and I was slated to speak right after that election, and it took a little bit longer to count the votes there. Probably would not have had the results on the original scheduled date for this, but Georgia did flip both seats. So we now have 50-50 divide in the Senate, meaning that Vice President Harris will give Democrats effective control. This has happened previously, most recently in 2001. We had a 50-50 Senate for the first 2/3, 3/4 of the year in 2001. And what they've done, the Senate leaders, Schumer and McConnell, have put in place a power sharing arrangement that is very similar to what Senator Daschle and Senator Lott did in 2001. They just put this in place about a day ago. I think Senator McConnell got what he needed was some assurances from a couple of key Democratic senators that they would protect the filibuster, which is the ability of to require 60-vote margins in the Senate to get things done on legislation. So he got comfortable that there were at least a few Democratic senators that would want to preserve the filibuster. So the power sharing arrangement is basically you'll have Democratic chairmen of all the committees in the Senate, but you'll have equal representation. So the Senate committees will all have equal numbers of Democrats and Republicans. If there's a tie vote in a committee, the bill will move to the floor without recommendation, but it'll move to the floor. It moves to the next step. So that's now in place. On the House side, the Republicans overperformed in the House. They picked up 11 seats. Democrats still control 221 to 211. There's 3 vacancies currently. There's an open, there's a seat in upstate New York that's still counting votes and recounting votes, but much narrower control in the House. So in both cases, pretty close partisan control in each House, very narrow margins. We'd like to think that would result in more bipartisanship. That may not necessarily be the case, but moderates in both parties will be sort of the go-to people on Capitol Hill to get things done. If you want to flip to the next slide, talk a little bit about personnel is policy, well, let's talk first about sort of, is there a mandate? We started this process back in, as I said, in October, thinking about what a blue wave might look like. That's what some of the polls were showing, that there would be significant pickups in the Senate and in the House by Democrats. That didn't happen. After the election and awaiting Georgia, we called it a blue ripple. And after the Georgia results, I think we're calling it a blue tide. All that is just sort of, we like to give things shorthand names here. So I think, again, given the role of moderates in both the House and the Senate, I don't see any really strong mandate. Things will have to be worked out, hashed out through regular order in many cases, and votes will be close. And as I said, moderates will hold a lot of sway on policy matters in both the House and the Senate. Compromise or partisanship, too early to tell. I'm going to bet on partisanship to continue. There's already talk of using budget reconciliation, and I put that in here. It's an arcane process. So in most cases, legislative issues in the Senate in particular have to move with supermajority votes. That's been the rules in the Senate for over 150 years. That still prevails on legislative matters. But there are processes, and budget reconciliation is one. It's sort of this arcane process that comes out of a budget agreement, which Congress doesn't always pass. But if they pass a budget agreement, budget committees can give instructions to all of the policy committees to meet certain spending and tax targets, revenue targets. And those bills get put together into a single large budget reconciliation bill. And those can move under special rules that are expedited and can get done on a 51 vote, one vote margin type of process. And so there's already talk by Senate Democrats they're going to use budget reconciliation in order to break any logjam in the Senate that might occur. In particular, likely to be using this on COVID relief legislation. I think we might get another week or two of conversations about trying to find compromise. But if that doesn't happen fairly soon, you've got a new administration focusing on the first 100 days. And I think they'll move fairly quickly to using budget reconciliation as a process to move COVID-related relief forward. The focus, I think the first 100 days is COVID, COVID, COVID. I think that's going to be really, whether it's in the health area of trying to move vaccines out and treatments out into the marketplace and really make that an effective and fast ramp up, as well as the impact of COVID on the economy. Those are going to be the two big issues for the first 100 days. And they've been outlined in numerous, both during the campaign and afterwards. COVID is number one, the economy is number two, a whole body of issues related to equity, inclusion, and opportunity. You will see be a focus, and you've seen it already in the executive orders and the presidential memoranda that have been issued just in the first week. And then climate change is the fourth big issue. And as I go through all of the issues that we're talking about here in the mortgage space, you'll see in almost every case, they're going to tie into one of those four top line issues. Once we get through the top line agenda, we'll pivot into things like tax reform, regulatory reform, or re-regulation, if you will, housing type issues. But I really do think the first 100 days is going to be focused on these four issues, and in particular, COVID and the economic situation will be the real focus. We can go to the next slide. Personnel as policy, we're starting to fill out the key cabinet slots. As I mentioned, Janet Yellen's been confirmed. Marcia Fudge, a congresswoman from Ohio, former mayor of a small city outside of Cleveland. She's been nominated as the HUD secretary. Her hearing, she'll have a hearing this week. There's talk of delaying the actual vote on her nomination until after the first 100 days, given the close margins in the House. They want every reliable vote they can get. So we're likely to see a hearing on her, but there's a possibility they'll delay the vote to get her in place until early March. Department of Justice, Merrick Garland has been nominated. The banking agencies, which are important for us, obviously. The Fed chair is in place until February of 2022. The FDIC chairwoman is in place until, I believe, June of 23. So those will stay. Although you'll see nominees to the board, not the chairman, but other nominees to the board and to the FDIC will come. FDIC will now be on a 3-2 basis. So they'll have 3 Democrats and 2 Republicans, but Chairwoman McWilliams will stay in that role until June of 23. OCC is open. Brian Brooks has left. He was the acting comptroller. We now have a new acting comptroller, so we'll see that appointment come, I think, fairly soon. In the next, probably couple of weeks, we'll get a nominee. There's a lot of rumors about Michael Barr, who was very active in the Dodd-Frank debate. He was an assistant secretary at Treasury for Obama. He's a professor at University of Michigan, and a fairly robust progressive, we'll call him. But the nominees have been a mix of what I would say progressives, centrists, and a few moderates. Many folks coming back from perhaps lower deputy roles in the Clinton and Obama administrations are coming back in higher roles in the new agencies. And a lot of folks from Biden's days in the Senate. So it's a real mix of viewpoints. I think the common theme is close connections with the president from his days, both in the Senate and as vice president. The 2 key independent agencies that we are most concerned with, CFPB and the FHFA. CFPB has, the nominee for director is Rohit Chopra. He is one of the first hires at the CFPB after it was stood up in 2010, 2011. He was the student loan ombudsman. Later on, he was nominated to serve on the Federal Trade Commission as one of the Democratic appointees there. He has been nominated to serve at the CFPB. I think this is one, he is a close confidant of Senator Elizabeth Warren. I think this is one that will probably run into some tough questioning on the Hill. May take some time to get that nomination through. Maybe some challenges to that, but I suspect it'll probably go through, but it may take some time. And then FHFA is the other independent agency, and it is at the moment subject to some litigation. There was a case before the Supreme Court that was heard in December over the constitutional structure of the FHFA, very similar to the CFPB, has a single director who can only be relieved of his duties for malfeasance, basically. This particular case is dealing with the investors in the GSE's junior preferred shares and the common shares, trying to get compensation for what they viewed as a government taking when the GSEs were put in conservatorship. But as part of that case, there was a challenge to the constitutionality of the structure of the FHFA. So there is a possibility the court is expected to rule sometime between March and June, and there's a possibility that Director Calabria, if they deem the FHFA to be unconstitutionally structured, Director Calabria could find himself let go, and a Biden administration would put their own person in as head of the FHFA. That's an open question, and we won't know how that's going to play out until the Supreme Court decision comes through. Next slide. I'll dive into a little bit more detail on all of these types of issues, but sort of the macro themes here that we're looking at is a shift from offense to defense when it comes to the regulatory infrastructure and oversight of the industry. This should not be a surprise to anybody. We've had a good few years. I think Director Kraninger was a really straightforward, straight shooter. As director of the CFPB, she put in place a number of process reforms that I think are very important. The ability to use advisory opinions, no action letters, and other processes that moved away from what we were calling regulation by enforcement, where we were forced to look at enforcement orders to get regulatory guidance. They really did move away from that, and they put in place process reforms that are still there. I think they'll be underutilized or utilized differently than they have been under Director Kraninger. Obviously, I think we'll see some rule changes that will tighten, not loosen the existing requirements. Those will take time. Rulemaking is a process. The Administrative Procedures Act requires, advance notice, and then the final rule. I think where you'll see the real difference is in the second macro theme, which is enforcement over supervision. So I think that the real tools that they'll have in the consumer-facing regulatory compliance area will be on the enforcement and supervision front. The rulemaking process will take longer, but the enforcement and supervision, the tenor of enforcement and supervision can move fairly quickly. So what that means is you'll have a shorter path from exam findings to possible supervisory enforcement actions, and enforcement probably being the preferred tool over supervisory MRAs and the like when they find something that they believe is significant. And I think when you do see enforcement actions, I think the settlements you'll see will be more punitive, designed to send a message, if you will. We had a webinar with one of our counsel the other day. The other point they made is what you might think of as an error rate in your compliance processes, the Bureau under new management is probably more likely to see that as a systematic error process. Something is wrong in your processes and systems. So again, something like that at lower thresholds, lower tolerances in place for those types of errors. They might see that as pattern and practice. You might see it as an acceptable error rate. Those are the types of things we would expect to see in the supervisory and enforcement area. I do think you'll see inspectors general being resurgent again. They were largely marginalized under the Trump administration. I see this particularly playing out potentially in the HUD arena. We've had spent the last 4 years working through trying to get the FHA certifications changed in a way that will give some protection from inspector general type of investigations that find very minor foot faults and turn them into treble damages. That stays in place, but I do think you'll see a much more robust, muscular inspector general operation. And then I think you'll see more coordination between the CFPB and the state attorneys general. And then the final macro theme, and the first two are obviously significant challenges. I think on the positive side, an opportunistic side, I think you'll see a shift from defense to offense on affordable housing and credit access issues. Certainly the entire issue of minority home ownership, particularly Black home ownership, where the gaps remain incredibly wide, going back 50 years plus in terms of the Black to white home ownership gap. I think you'll see a lot of focus in there, coming both from industry and from the administration, obviously. Sort of in the turning of the dials, I think you'll see, particularly if you get a new FHFA director, opportunities for wider credit boxes in the GSE programs. I think you'll see it in FHA, certainly where Brian Montgomery had been trying to tighten things up a little bit, particularly in areas of risk layering. You might see some relaxation in that space. Talk of possible mortgage insurance premium cuts, that sort of thing. That will depend, I think, on the impact of COVID-19. But we're actually hearing some rumblings that they might move sooner on that than I would have expected previously. And then targeted programs for certain populations, workforce housing in particular, teachers, firefighters, nurses. And then energy efficiency, again, tying into those top line themes, energy efficiency type products. Will we see a comeback of the PACE product? We hope not. But other ways to provide credit in underwriting for energy efficient properties, that sort of thing comes back. And then the possible use of the tax code to incentivize certain activities. So I'll dip into some of these a little bit more in some in the following slides. You can go forward, looks like 2 slides here. I'll sort of go into some specific areas where outline sort of trends that we see on the GSE reform front. First and foremost, I'll note we spent a good part of the end of last year aggressively working with the Treasury Department to dissuade any effort to release the GSEs from conservatorship before putting in place any reforms that are necessary. And most importantly, making sure that the full faith and credit, the $254 billion of Treasury backstop remains firmly behind the GSEs. There was some significant concern that they would be released. Director Calabria working with Secretary Mnuchin, trying to get them out of conservatorship in an irreversible fashion before the end of Secretary Mnuchin's time as Treasury Secretary. We played this out mostly in private, in numerous meetings with Treasury and NEC, just trying to walk through our concerns that if they were prematurely released from conservatorship, if there were any questions about whether the Treasury backstop was firmly behind them, we were concerned about market disruption. Fortunately, while there was some amendments to what we call the preferred stock purchase agreements, the PSPAs, they did not release them from conservatorship. That's positive. They put in place some important reforms around locking in things we've been advocating for that have been put in place because they were in conservatorship. We need to lock them in for the long term. So issues around guarantee fee parity and level playing field between small and large seller servicers, those sorts of things were locked into the PSPA as well. There are some aspects of it. There was some what I would call tailoring of the GSE footprint in that document, limitations on investor properties, second homes. Not aggressive. I would say they were reflecting current market shares, but that type of capping of volume, I think our concern is limits flexibility as market trends shift and move. And we'll continue to work on trying to get some flexibility around those. And then many of you probably know about the cash window caps that were put in place. Those don't go into effect till 2022. We have some significant concerns around those caps, and we'll continue to work on those. So on the—
Hey, Pete?
Yes.
I just have a quick question. As you were touching on the GSEs and reform and some of these things in your first point, can you talk a little bit about the half-point GSE refi fee and whether or not if you feel like that's going to remain in place in the long term, or is that just kind of with us forever and we're just going to have to get used to it, or and where is that? How is that money being used, or is it just an insurance policy, or, can you help us understand that?
Yeah, great question. The purported need for the adverse market fee is that the GSEs are expected to incur, and the numbers have varied from anywhere from $6 billion to $12 to $15 billion in costs and expenses due to COVID. Obviously, when they have to reimburse servicers for advances and those sorts of things, those will be a cost. Those numbers seem high. The GSE profit numbers seem strong. So our anticipation or our expectation is we'll be advocating for, particularly if we see the next quarter or two of earnings coming in as strong as they have been, we'll be advocating to get rid of that fee. For now, I would say it stays. I think this is one of those issues where if there's a change in leadership at the FHFA, the chances of getting the adverse market fee repealed go up. But for now, under the current director, I think it'll stay in place. I think he's inclined to wait a few more quarters to see how the GSEs and how the costs from the COVID related impacts, economic impacts, are affecting the GSEs before he'll take any move on that particular matter. I'm hoping we learned a lesson that any sort of changes like that should not affect existing pipelines. That was something we spent quite a bit of time on back in late summer, early fall. So I think macro level GSE reform, and this is presuming that there is a different director in place. If Calabria if the Supreme Court says the constitutional structure of the FHFA is just fine, he'll be there for another 3.5 years. The pace of play under Director Calabria has been extremely brisk. We have think 6 different rules and requests for information, what we call RFIs, out right now currently on everything from the sort of the future of the appraisal process and the appraisal industry, climate change, IMB capital and liquidity is coming out sometime in the next few weeks. A whole host of issues. He is on a very brisk pace. Under a new director, we would expect that pace to slow significantly. A lot more deliberative process, and a shift in focus. Right now, I think Director Calabria is focused on primarily taxpayer protection and shrinking the footprint of the GSEs, and trying to prepare the GSEs for an eventual IPO. I think under a new director, I think you'll see the focus shift off of taxpayer protection more towards access to credit, cost of credit, and refocusing the GSEs on more mission-oriented activities. So more focus on LMI issues, trying to reach down further into the credit spectrum, trying to help communities that are underserved, those sorts of issues. So I think you'll see a pause on the aggressiveness of current activities. I think you'll see probably a re-examination of the capital rule that most of us thought was probably too conservative, a little bit too tough. And so they'll probably do some quantitative impact studies there that might allow some recalibration of the capital rule. I think the issue of G-fee parity, which you see on the slide there, that was largely addressed through the recent PSPA. So that's a positive. But I do think under new director, you'll see some additional credit box changes, increased use of cross subsidies between highly profitable business that might be targeted or not targeted in order to cross subsidize efforts at the lower end of the market. So just again, a change in tenor under a new director is what we would expect. If you go to the next slide. Fair lending will absolutely be a focus, again, tying back into those top line themes for the Biden administration. The Trump administration was criticized for weakening the existing fair lending rules. Disparate impact and affirmatively furthering fair housing were two real lightning rod issues for the civil rights community. And just yesterday, there was a presidential memorandum came out calling on HUD to re-examine the recently issued disparate impact rule. I think there's a real desire to go back to the 2013 HUD rule. Our view is that somewhere between the 13 rule and the 20 rule is probably the right spot. But we'll have to wait and see how that plays out, whether HUD, if they go through rulemaking process, would have to repropose some other alternative version of the rule. If they attack it on Capitol Hill and try to get it repealed through what we call the Congressional Review Act, that would take us right back to the 13 rule. But that will be a significant focus. We've already seen that come out just in the last 24 hours with the memorandum that came out the other day or yesterday. And I think certainly on the enforcement side, both HUD and CFPB will make fair lending an enforcement priority going forward. So you'll see us doing a lot more webinars on fair lending issues and making sure that folks have good compliance management processes in place to manage fair lending. So again, withdrawal or revision of the disparate impact rule, expect that. Increased enforcement coming from HUD, referrals from the banking agencies to the DOJ and from CFPB. I think you'll see some new approaches to fair lending emerge. We've already started to see that a little bit, even under the current Bureau, looking at non-bank lenders for redlining issues. Redlining has typically been a banking concept. They're beginning to use peer grouping and comparing lenders to their peer groups to see, are they avoiding certain areas with where they put their branches or where they try to advertise and reach out for business. Definitely expect to see that continue. I think risk-based pricing could come under some fair lending type of analysis, looking at alternative ways to limit costs on minority households. And then the most aggressive version is to try to link violations of RESPA as also being violations of fair lending. If protected classes are most impacted by violations of a consumer protection rule, there could also be a fair lending claim embedded in that. That's something we've seen some of the advocate groups argue for. So these are all trends that we're going to keep an eye on, things you can expect in the fair lending arena. And then new areas.
So Pete,
yes.
Another question, sorry.
Yeah.
So going back to your new approaches to fair lending will be tested, the constraint, the risk-based pricing. So in your opinion, do you feel like there will be any effect on the non-QM market for mortgages not sold to Fannie Freddie that certain investors retain? Do you think, I think the perception might be for some that is classified as risk-based pricing, but it's also, you know, non-QM product. So do you think that market would be affected at all by this?
I mean, I can see a fair lending analysis that would say, you know, our minority families being steered more into the non-QM space than in the QM space. You can see some pricing disparities that arise out of that could be the subject of a fair lending analysis. I think there are good defenses to that, but again, I think that's where you'll see some of the challenges. And then I think two significant areas, appraisal discrimination is becoming a significant issue. Again, even under the current FHFA, the RFI that's currently out asks for feedback on to what extent is there appraisal bias in the marketplace that needs to be addressed. And then the entire credit reporting, credit scoring process, a lot of concern that it kind of cuts two ways. In some ways, new approaches to you know, fintechs that use alternative underwriting hold some promise for reaching some of those. But if they don't meet that promise, there'll be a lot of analysis around whether some of these alternative underwriting approaches that are being used by some of the fintechs, not necessarily in the mortgage space so much because it's predominantly a government-backed space, but some of that new approach could make its way into the mortgage space. Some look into whether or not the credit reporting system and the credit scoring system is in and of itself biased. There's even been talk of standing up a federally sponsored or federally run credit bureau is one of the things we've heard some discussion of. So a lot of significant issues in that space. If we go to the next slide, and I think this is fairly self-evident, we've covered this fairly well already. Certainly under a new CFPB director, a lot more aggressive enforcement and supervisory actions coming out of violations. As I said, what youth might think is an error rate, the new CFPB might see as a pattern and practice violation. So you're going to want to have your compliance management systems highly tuned, responsive to findings from internal audit, responsive to trends you see in error rates, responsive to consumer complaints. You really need to be buttoned up and good hygiene in that space, I would say. I think, you know, we've been working on the LO comp rule for years now. We've gotten it onto the CFPB's agenda, the regulatory agenda. We'll try to move it off and get some progress on it. I actually do think there is a tie-in, particularly when you look at the impact on bond loan programs of the LO comp rule. We might be able to make some progress there, but it's going to be a tougher slog to convince the Bureau to make changes to the rules that we see as giving us clarity. They might see as taking away enforcement or supervisory optionality on their part. So tougher road there. I think this one of the more significant areas. I don't think it's a slam dunk that the CFPB is going to come out focused on mortgage. Mr. Chopra has a different background over at the FTC. And when he was at the Bureau, he was focused on the student loan issues. I can see payday lending, some of the small business lending issues that are currently very active, debt collectors being his immediate focus. But the mortgage areas, I think they will focus on. Fair lending, we've already talked about. And then I think significant scrutiny of mortgage servicers as borrowers migrate from forbearance, which was fairly easy to give because there was very little paperwork, no paperwork. But as these borrowers exit, how are they exiting? How are lenders implementing all the forbearance exit options? Are they doing it fairly? Are they doing it efficiently, quickly? Or are borrowers being moved quickly down the foreclosure path? I think there'd be a ton of scrutiny in that issue, both from the CFPB, but I can also see a lot of coordinated action between the Bureau and the Attorneys General. So again, that's an area where from a compliance standpoint, you want to be buttoned up. You want to make sure not only that you're doing it efficiently, but I do think there will be sort of a fair servicing type of approach. Are borrowers being treated fairly by protected class in terms of the forbearance exit options that they're being offered? So again, that's an area you're going to want to be very, very well buttoned up. And then in terms of some of the Hill issues that will spin out of this, certainly we're expecting as part of the COVID relief packages, the possibility of expanded CARES Act protections, both longer period of time for folks to seek protection under the CARES Act, seek forbearance under the CARES Act framework, and also the possibility of extending the time in forbearance. So 2 issues to keep an eye on. That could be legislated. They could also be addressed through administrative action. And that's one of the things that the Biden administration is already moving on at HUD to extend forbearance certainly through the end of March and possibly further. That's eligibility to seek forbearance. I would certainly expect at some point extending the time in forbearance as well to help borrowers through their COVID-related hardships. That's a tricky issue. At some point, extended forbearance becomes almost impossible to recover from. So I think real challenging issues for servicers going forward. Go to the next slide. Affordable housing is a real opportunity for us, I think. It will be a major priority, particularly looking at minority homeownership issues and trying to close the homeownership gap, but ultimately trying to close the wealth gap between minority and majority households. So beyond the fair lending issues, possible efforts to expand the Community Reinvestment Act to non-bank entities, both independent mortgage bankers, but also into the insurance space, credit unions, which are currently exempt from CRA. I expect that to be a hot topic on Capitol Hill. I'd expect hearings on that probably in the spring and then perhaps some legislative action in that space. I think particularly if they move into direct spending activities, so down payment assistance, using the tax code to incentivize homeownership. The Biden-Harris campaign had a proposal for a $15,000 first-time homebuyer tax credit. Now there's talk of trying to make that not only refundable, but advanceable. How can we get that money to the closing table as down payment funds? I look at that and go, why not just create a down payment assistance program with federal dollars? It's a lot easier than invoking the tax code and all of the tax reporting obligations that flow out of that. It's a simpler way to go, but that's the kind of big ideas they're looking at in terms of trying to address the minority homeownership issues. We've touched on some of these other issues in the slides, the possibility of a premium cut in the FHA program. I think we had expected that they would wait on that until they could see you've got some 800,000 FHA borrowers that are in forbearance currently, significantly high delinquency rate there, that they might wait to see how those borrowers exit before doing anything on a premium cut. But we're hearing rumblings that may come sooner. That's something to keep an eye on for sure. Again, I think I mentioned this previously, this whole issue of energy efficiency and resiliency, disability access. I would expect, not in the near term, but over time, some programmatic changes designed to address some of those issues. We're particularly concerned about the resurgence of the PACE loan program, and we'll be actively engaging both with community organizations, which actually support us on this. We are very much aligned that the PACE program is not good for homeowners, nor is it good for lenders, the whole super lien process. And you may not have it in Minnesota right now, but it may come. We'll be actively coordinating with some of the advocate groups to prevent a resurgence of the PACE program. Next slide. Prudential supervision, you're going to hear a lot of talk, particularly focused on the largest banks. Capital relief for large banks, harder to come by. Some conversations around a big bank tax, financial transactions taxes, those sorts of things could certainly impact both corporate and consumer borrowing from the largest institutions. I think, again, tougher prudential requirements. There's been a lot of tailoring, if you will, of certain aspects of Dodd-Frank that were challenging for the banks, Volcker rule, those sorts of things. I expect some efforts to reverse some of those issues and holding the banks to significant, particularly the larger banks. I think this is really focused on the top dozen or so largest banks in the country. I think community bank relief probably will largely stay untouched, but some of the things that the largest institutions have been able to get through the regulatory process might get reversed under a Biden administration. And then in a couple of other areas, I would say under a new FHFA director or under the current one, I still think you'll see a lot of focus on non-bank lenders and servicers from a capital and liquidity standpoint. I don't think that's a partisan issue. I think that is I just think it's a lack of understanding about how the market works. We've continued to educate in that space and dissuade them from overreaching. But I think that will be an area that will be active under either Director Calabria or a new FHFA director. And then one area, home loan bank access for REITs and for independent mortgage bankers. I don't think Director Calabria is a fan of either, but I do think under a Biden administration, as a housing stabilizer of getting the home loan bank system to support more of the market, particularly as IMBs grow, as REITs become holders of mortgage assets, much more significant. If you want a home loan bank system that serves the whole market, you're going to have to revisit membership in the home loan bank system. So that, I think, is one that is a possible opportunity under a new administration, under a new director.
Say, Pete, we
Yep.
have just a comment in the chat box.
Yeah.
One of the attendees was questioning whether or not we really need more down payment assistance programs, asking about solving the LLLL issues around new construction.
Yep, labor, land, yes. The new construction issues are challenging. I do think trade policy for housing has not been good under the prior administration. So hopefully better trade relations with Canada in particular might help on the lumber front. The land front is challenging given that that all plays out at the local level. There will be some efforts started under the Trump administration. We'll certainly try to continue them, maybe to try to use carrots and sticks with federal dollars to encourage localities to be more flexible. I know Minneapolis is one of those, I think it's Minneapolis, one of the localities that is really relaxed zoning restrictions in order to encourage more affordable housing. That sort of thing, if it's rewarded with additional federal dollars, is something we might be able to begin to see elsewhere. Those are much longer tails of opportunity there that will take time to play out. And then labor is the other big one, where I think immigration reform that allows, whether it's a guest worker type program, other ways of addressing the labor shortages. But the building industry is facing all those. And then the fourth L is lending or loans. That's been less of an issue when we talk to the home builders. Certainly some flexibility on acquisition, development, and construction lending. They'd like to see some additional work there. But those issues, the supply issue is a very long road to work on. Certainly we'll stay focused on it. but there's no direct levers on those issues is the challenge. Yeah, opportunity zones. I think they'll try to retool some of those tools to produce more supply. That's a good question, by the way. On the prudential supervision side, I guess the last item I would mention there, I think we covered all those. So if we move to the next slide, tax policy is a biggie. I think with the Georgia results, I think it's more likely we'll see some effort to roll back some of the 2017 Tax Cuts and Jobs Act provisions. And so kind of break those down into three buckets, if you will. On the corporate side, as you recall, I think we went from a 35% top corporate rate to 21. I think there'll be a significant effort to push that back up. So if you're a C Corp, that's a challenge. I think at the same time, they'll try to narrow some of the benefits for pass-through entities, S Corps and LLCs. We were able to get some significant benefits, and we actually worked with Treasury on getting the rules to make changed or clarified in a way that would make sure that independent mortgage bankers and community banks could take advantage of those pass-through deductions. I think those will get probably efforts to chip away at that and maybe put hard income limits in place that will limit the benefits of the 199A deductions. And then financial transactions tax, big bank tax, those are possibilities, probably more difficult given the close ratios in the House and Senate. On the individual side, I think they'll try to bump the upper tax brackets back up and probably try to increase or tax capital gains as ordinary income. And then on the housing front, then some potential positives here, this notion of first-time homebuyer tax credit, refundable, possibly advanceable. I think once you get into the advanceable space, you might as well just make it into a down payment assistance program, a grant program, as opposed to a tax program. But that will get some attention given that it was part of the Biden-Harris campaign platform. Tax exempt bonds probably will get some benefit, although not much use of tax exempt bonds given how low rates are currently. And then the last area, 1031 exchanges certainly will be in the crosshairs, and possibly some additional tailoring of the mortgage interest deduction, although I think it's become such a small corner of the market with the increased standard deduction to $24,000. Fewer households are using it. They're taking the standard deduction instead. And so it leaves the MID out there as something that is a potential target to raise revenue from higher income households. So that's a potential there. And I didn't mention on the slide, but what we call the SALT deduction, the state and local tax deduction, probably will get revisited in a way that will eliminate some of the punitive treatment of high property tax states, which tend to be blue states. That was viewed as a very political change to the tax code to punish higher tax blue states. I think you'll see some effort to make some modifications there as well. The next slide, and I think I see we're running up into time issues here. So I would just say that in particularly in the blue states, you'll see some of the issue trends start to mirror each other. And in a number of states, California is a great bellwether state for this, as is New York, both very blue states. They will try to do things if they feel like the Biden administration, if the progressives in California feel like the Biden administration is moving too slowly, they'll try to do things in California to force action in Washington. We've seen that in California with privacy, extremely strict privacy legislation, trying to goad federal government to do more. I think we'll see that continue with the Biden administration if they're not moving fast enough. I also think the other significant area here is in coordinated actions between the Bureau and the state's Attorney General. So that's an area to keep an eye on. And then last slide is an advertisement. If you want to move to that. I will, Sarah, you mentioned the adverse market fee. We were able to beat that back because we had 85,000 letters come from our industry, from our Mortgage Action Alliance, to members of Capitol Hill, to write letters to Director Calabria, to raise concerns, to ask tough questions. And he felt the pressure, and it is a tremendously valuable tool for us. If you haven't done it, please just download the Mortgage Action Alliance app on your phone. It takes 5 minutes. When a call to action comes out on an issue you care about, it literally takes just a few. I've done it during meetings where I've been able to send a letter to my member of Congress on an issue that we're talking about in that meeting. So when we do a call to action, the MA app allows you to send letters to your member of Congress, to your senators, in less than 5 minutes. It is a great tool. It's hugely valuable to our lobbyists when they go to the Hill to have that grassroots constituent backing what they're telling their members of Congress. So make a pitch there. MORPAC is our political action committee. Would encourage folks to get engaged there as well. Keep your eyes open for a spring virtual Capitol Hill event that we're going to try to do. And I'll stop there. I have a few slides that if you post them and send them out to folks that cover some of Mike Fratantoni's economic forecast. The long and short of it, I can probably do these in a minute. If you go to the next slide after that, short-term interest rates, lower for longer, long-term rates, you can see Mike's forecasting trending up starting in 2021, about 50 basis points, and essentially 50 bips per year in 2022 and 2023 on long-term treasuries. The GDP growth strong this year, slowing significantly in 22 and 23. You go to the next slide. This is all leading to a story here. Here's long-term rates and the Fed funds rate sort of plotted over the long term. Again, trend line up over the coming 2 to 3 years. Here's the impact on the purchase and refi markets. The red bar is purchases, continuing strong purchase market, really driven by demographics. This cohort of millennials reaching prime home buying age is significant and will be a real powerful force in the purchase market. But you can see refis really just sort of going off the ledge there between 2020 and 2021, particularly by the latter half of the year. Next slide, home prices finally slowing a bit. And the next slide, this is the one I don't like. Margin compression is back. So tight margins, you're probably already feeling it. We're starting to see it in the data significantly. And that's always a challenge for our segment of the industry. So I'll stop there. A minute passed. I'm happy to take questions. I can stay longer if there are questions.
Well, Pete, I want to just say on behalf of the MMA and all of our members and our community, this has been immensely helpful and very insightful. I took 4 pages